Alright, hi everyone. In this video, we're going to be talking about covered calls and how should we be executing them in the correct way. Well, a covered call is always going to be done within an uptrend, most of all. Most of all in an uptrend, not much in a downtrend, just because when you're covering a call, which I'll discuss about, you need 100 shares of the stock. So here's an example. Usually the way how I execute a covered call is whenever the share price has already gone up. So it's the sort of the inverted way of a cash secured put where you're looking for the price to be dropping to expect a reversal. In this case, you want the price to be rising to expect a reversal for a counter trend. So the requirements, of course, in order to do this in a technical pattern, as you guys learned within stock trading, is to have the oscillators. So usually when the charts don't have any resistance areas within an uptrend, you do need to have three oscillators to be oversold, which have to be all three of the Bollinger Band, Stochastics Full, and Williams percentage R. So that would obviously, of course, the requirements in order to do a covered call is the same sort of technical requirements within the charts, same as the R strategy within the stock trading. So to kind of simplify it, first, if the price doesn't have any resistance, it needs to have three oscillators showing it's oversold. On top of that, it needs to show a candle reversal pattern. It has to be far away from the 20 moving average too. And of course, that there isn't as much support areas above the 20 moving average that could effectively challenge the price to come down. That's really what you're doing here. You benefit as the price stays below your strike. So let's say you decided to execute a cover call strategy right here on this day. And if you did this, you would have sold a call a little higher than what the current spot price is. And then let's say that you sold that call for the next more than 30 days, let's say for 40 days, you sold it at a higher price, and 40 days have passed, you see that the share price has gone down. Now it's starting to go up, but it's not above your strike price, which means that your strike isn't within the money. And as you guys know, when you guys learn the nature of selling options, when an option is out of the money towards an expiration date, it has no value whatsoever because it doesn't have extrinsic value, which is what's left in an out of the money call option, or at least out of money in any option. So let's really talk about that. What are covered calls and how should we use them? Well, covered calls comes from its name out of itself. The call is covering your 100 shares. So this strategy can only be used and strictly be used if you have at least 100 shares already in a stock that you own. So that stock, of course, needs to be a fantastic business. This strategy only works in every scenario if it's a fantastic business. If you don't know if the stock you're owning is a fantastic business, after this option course, do the investing course so you know what makes up a great company. This strategy is the inverted version of a cash secured put. Because this time you need to own 100 shares, and the calls you will sell at a much higher strike has a big probability that it won't be hit. Similar to cash secured puts, where you had a probability within the delta, of course, and within sort of supports, that the price would respect that area and go up. Well, in covered calls, of course, majority of the times, depending what type of circumstance you're in within the trend, but when you're in a trend where there hasn't been any, where you're at basically all-time highs, really of course, there's not going to be any resistance, but what you could basically do is just use the oscillators and find enough room where you can say, all right, the price definitely looks overstretched, it looks overbought. There's a bigger probability from here that the price won't continue up, but rather to go down. So you would sell a call higher because your analysis, your decision is basically saying that the price cannot overexceed the call option in order for it to be in the money. So also, in this strategy, you're really going bearish temporarily in your stock, since you need the price to maintain itself below your strike price so you can collect the full premium. Also, in covered calls, different from cash secured puts, because in covered calls you already own 100 shares. You can own more than 100 shares, but in this case, if you're doing one contract is equivalent to 100 shares. And because when you own 100 shares, you won't have any, your buying power would be at $0 because you already own 100 shares. Why would the broker be demanding you to block out collateral from cash in your account if you already have the position in your account? So that wouldn't make any sense. Just to let you know, in case you guys are confused, the only time that it will tell you a buying power is that if you don't have 100 shares of the stock. If you do, you will never get a buying power when you do covered calls. So let's break down the rules, because there is rules within this strategy similar to cash secured puts, but there is a lot more rules because it's think about it. You're selling calls on a really good company. You need to really make sure you need to know what you're doing, because a good company can temporarily fall, but eventually it will always rise. So you need to be very diligent. You need to be responsible, and aware of the circumstance, what the market's in, and based on that facts to provide the appropriate strategy to benefit what circumstance the market's in. So the rule number one, you need to own, of course, at least 100 shares of a great business. Two, sell a call 30 or 40 days ahead to expiration. Usually I would say 30 to, that's for the first call. For the second call, it could be 30 to 60 days. For the third rule is that the option has to have more than 30 delta or 0.30 delta, and it has to have less than 0.50 delta. Now, another rule is that when you see the price can't go up technically in the charts, if you see the price can't go up from here, but you're not completely bearish for the moment, only choose a delta between 30 to 45 delta. So what do I mean by very bearish? Well, for me, a very bearish, let's say, indication is, let me give you an example. If I see the price is overstretched, so first it has to be overstretched. Like that's rule number one. It has to be overstretched. It has to be above the 20 moving average. It has to, I'm talking about something that's very bearish. So it has to be very overstretched. It has to be far away from the 20 moving average. It has to meet a resistant line. So there's a strong resistant line hitting the price currently. Third, it has to be overbought too. And of course, fourth and fifth. Fourth is that there's a reversal candlestick pattern showing. And fifth is that there's enough room, of course, that the next possible area where the price can go to meet at support is very far from where the current price is at. So if the price you see, rule number 5 is that if the price you see has a lot of indication that the price really can't go up but from here, and there's a lot of room for it to fall for a correction since the next support below is far, then you can find an option between 40 to 55 delta. So let me reiterate that. If you're going to execute a covered call strategy, you're basically going to do a counter trend trade within an uptrend. To do that, you need to make sure if it's very bearish or bearish but not as bearish. If it's not as bearish, the delta could be 0.30. It needs to be 0.30 between 0.45. It can't be more than 0.45 because anything usually more than 0.45 would be at the money. And what you're basically saying is that the price can maintain itself basically at the current price is at the share price and not go above that, which of course that's very bearish. So because of this, that's why you should choose a delta between 30 to 45, as that's not as bearish compared to the 40 to 55 delta. Now, what's a not very bearish scenario? Well, if not very bearish scenario could be at least that you don't have like all the 5. So let's say you have it over, let's say that the price is above the 20 moving average. It's showing a reversal candlestick pattern. It's overbought, and you see that there's a bit of room for it to hit another support, but you don't see it's completely overstretched, but you do see it's overstretched and it's not hitting a resistant area. For me, because of those two, that's not very bearish. Now, another rule, you need to make sure that the options premium is 1.8% to 4.2% of the entire net purchase. So as you guys know, the cash secured puts, the option premium was 1.8% to 3.5%. But in covered calls, you need to be 1.8% to 4.2%, just because you're going to be usually entering options that are pretty close to at the money or at the money. That's why. So you need to make sure that that premium is good enough to offset whatever you're going to potentially maybe lose in overall within your investment, which is unlikely to happen if you bought the investment cheaper. So another rule is that if there is only 7 days left for the option to expire, you need to make a decision now. So if the option is in the money, you should decide whether you're okay to let it expire, and you will sell 100 shares of that stock, or that maybe you don't want to sell the 100 shares. Then you would rather just close the call for loss and open another call at another further expiration date to cover the loss of the previous call. It's similar to the same nature when you're rolling the puts within cash secured puts. Within cash secured puts. You're going to be rolling it, but in this case, you're going to be rolling the call. And the way how you're rolling the call in this is the exact same way as you roll the put within CSP, because you know that in CSP, we don't casually do an order to roll. Instead, we just manually close the current option, and then after we close it, we then open another option, another further expiration date manually. But we don't enter it all at once because we want to bargain with the price. We want to enter at the mark price, not the bid price, the ask price. We want to bargain with it. So that's why I don't like to enter in automatic rolling order. And another rule is that if your option, so let me summarize that again. If there's only 7 days that you see for your option to expire, like when it's already 7 days, you need to make a decision. You can't wait until the next day, anything like that. Like your deadline is going to be 7 days. If you see that the option's in the money, you need to have two things, like you need to decide two things. If you want to sell your 100 shares at the current strike price, regardless of what the spot price is, then you can just let it expire. It doesn't matter. You can just let it expire because you're fine with selling the 100 shares. But if you don't see to sell the 100 shares, then you have to close at that same day in 7 days. You have to close it for a loss if it's for a loss, and open another call at a further expiration date to cover your loss, to cover the loss of the previous calls lows closed. Now, if your option, so if your option, whatever time it has left, whether it has 20 days or 3 days, if your option goes above 0.80 delta, which is obviously in the money, you need to close it immediately for a loss and open another call that's 30 days, that's more than 30 days ahead to cover that call's loss. Now, the reason why you always need to close a short call when it goes above 0.80 delta is because, think about it. If you guys remember the lesson of the vocabulary where I explained delta, delta means two things. It's based on the probability that it can stay in the money, and another thing is that it's the amount of what the option moves per dollar. So if the option in this scenario goes above 0.80 delta, let's say it goes to 0.90 delta, what that basically means is that if the stock moves by $1, the option will move by $90, almost like 100 shares. So if you're currently owning a piece of the business, I mean, you're owning a few hundred shares of a company, and you've been benefiting. But if your option now is more than 0.80 delta, what's basically going on is that whatever your investment's gaining within the share price will be hugely deducted, like if it didn't move to that gain because of the option that's now more than 0.80 delta. Because think about it, if your investment moves by $10, let's say, you're gonna make $1,000, of course, because it's 100 shares per dollar movement. That's 100 times 10 is $1,000. But if your option is at 80 delta, what that means is that your option is going to lose in value by $800. So in reality, net in total, you're not making $1,000. You're just making like 20% of that. So that's why it gets like way too close. So it really interferes with your gains within your investment, which you don't want to do. That's not the point of covered calls. You want to make sure that in total, your long position is gaining by a big portion compared to what you're shorting in the call. So, the same rule applies as well. If you see the price really can't go up, but you're not very bearish yet, then choose a delta 0.30 to 45 delta. But if you are very certain it can't go up from here, then choose a delta for 40 or 55 delta. So what I said there was that after you did your first call and then you roll it and do the second call, whatever call that's after the first one, it's the similar rule. If you see that the current price right now, if your first call lost because it went up, then you need to make sure that the current price it's at right now, if you're losing, right? If you lost, because that's what it is, you close position for your loss and you want to roll another one, then you need to make sure that where the current price is at right now, if you see that it's not very bearish yet, but it's likely to go down, then choose a delta of 30 to 45. But if it's very bearish, then choose one that's 40 to 55. That's all. It applies no matter how many times you roll it.